So in this video I'll share my new findings on dividend investing. So when making this video, these are the stocks I own. So 3 different Vanguard ETFs. It's the S&P 500 ETF, the All-world ETF and the Emerging Markets ETF. So although these ETFs do pay dividends, they aren't necessarily dividend stocks or dividend ETFs, since the dividend yields on these ETFs aren't that high. But more on that later. So I'm exploring various investing strategies, including dividend investing, to decide whether this is worth pursuing, instead of solely heavily investing in the S&P 500 ETF and the All-world ETF. So in this video I'll cover 6 learnings I took away from recent reading on dividend investing. So learning number 1. It's not likely you'll beat the S&P 500. So as you may or may not know, I just finished my first book on dividend investing, The Dividend Growth Machine. And in one of the book's first chapters, the author writes about the S&P 500 in comparison to dividend stocks. So he literally writes, is beating the S&P 500 really your goal? Then if so, then dividend investing might not be for you. So the ultimate goal of choosing dividend investing is so you can pay your annual living expenses with the dividends you receive from the stocks you own, and not to beat the S&P 500. So learning number 2, you don't need lots of money to start dividend investing. So in the book Dividend Growth Machine, the author explains that if you have less than $10,000 to invest, you're best off by purchasing high dividend yield ETFs like the Vanguard High Dividend Yield ETF. And if you have more than $10,000 to invest, you can pursue purchasing individual stocks. So the author makes this distinction because of the high transaction costs of $5 to $10 per share to buy and hold individual stocks. So according to the author, it doesn't make sense to purchase individual stocks if you only have $1,000 to invest. But I don't think this argument still stands, because this book dates from 2016, so already 5 years ago. And since then there are plenty of new investing options available, like the broker Robinhood in the US, to purchase 1, 2 or more stocks to near zero fees. But also the Giro here in Europe, for example, offers such options for near zero fees. So in other words, the amount of money you have available to invest isn't the reason any longer whether you start dividend investing or not. So learning number 3. 2 ways to start dividend investing. So as far as my knowledge goes, there are 2 ways to start dividend investing. You can buy ETFs that focus on dividend stocks, or you can spend time on stock analysis and select your own dividend portfolio. So you can select ETFs or your own stock portfolio. So in regards to what ETF you can buy, there are various options. So the author of the book Dividend Growth Machine favors the ETF, the Vanguard High Dividend Yield ETF. So as of now, this ETF holds 412 different US stocks. So to be clear, this ETF doesn't contain other stocks than US businesses. So I've tried to find this ETF the author favors in my brokerage account, the Giro, but can't seem to find it. But there are plenty of other similar ETFs that are available to me as a European retail investor. For example, there is this ETF called SPDR S&P US Dividend Aristocrats ETF. So it's a long name, but that's the ETF. And speaking of dividend aristocrats, there are numerous dividend lists you can invest in or pick individual stocks from. And this is a good transition to my 4th pointer of this video. So learning number 4, dividend company lists. So what was new to me was the fact that there are numerous dividend company lists to invest in. Namely, the dividend achievers, the dividend aristocrats, dividend champions, dividend kings, blue chip stocks, and probably way more, but these are the popular ones I could find. So to be featured in one of the dividend achievers lists by Nasdaq, you as a company need to meet various requirements. So one of those requirements is that your company has a track record of dividend growth for at least the last 10 consecutive years. On Nasdaq's website you can see various indexes of dividend achievers. For example, there is the Dividend Achievers UK list, the Nasdaq International Dividend Achievers, and a few more. And you can click around to see what companies are in these indexes and how to invest in them. So the big advantage of buying such an ETF that follows one of these indexes is that you don't have to do the heavy lifting. For example, as you can read on Nasdaq's website, they will evaluate the index annually and check whether the companies in the index still meet all the criteria to be featured in the index. Furthermore, each quarter the index will be rebalanced, meaning they don't want to see any one of those companies exceeds 4% of the index. So in other words, they want to prevent one company from containing more than 4% of the total index. And it's probably to avoid overexposure to only one company. So if you're selecting and buying individual stocks yourself, you need to do these things yourself, which requires lots of your knowledge, time and energy from your part. And besides the dividend achievers, there is the dividend aristocrats list. As of now, there are 65 dividend aristocrats companies. And to be eligible to be on this list, the company needs to meet some criteria. So for starters, they need to be a member of the S&P 500. Furthermore, they need to have increased total dividends per share amount every year for at least 25 consecutive years. And for more information regarding the criteria and how they assemble and maintain this list, check out this page on spglobal.com's website. I'll make sure to leave links to all the mentioned resources in the description below this video. And just so you know, there are some variations to the Dividend Aristocrats Index. For example, there is the SPDR S&P US Dividend Aristocrats ETF. And to be eligible to be on this ETF list, you need 20 years of consecutive dividend growth instead of 25 years like the SP Global's Aristocrats Index. So at the time of writing, the SPDR Aristocrats ETF, so the one where you need 20 years of consecutive dividend growth instead of 25 years, holds 112 different stocks and pays an annual dividend yield of 2.2%. So the current price of one share of this ETF is 57 euros, meaning you'll receive around 1.25 euros in dividends per share you own every year. And just as a reference, one of the most popular ETFs, the Vanguard S&P 500 ETF, pays a 1.1% dividend annually, or in other words, 78 euro cents per share for the last year. And to paint you a picture here, if you were to have $1 million invested in the SPDR Aristocrats ETF of 2.2% dividend yields per year, you would receive $22,000 per year, or in other words, $1,833 per month. So to put things into perspective, if you were to have that same $1 million invested in the S&P 500 ETF that pays a 1.1% dividend per year, you would receive $917 per month instead of $1,833 per month. So the thing is, the S&P 500 ETF I'm currently buying has an average annual return rate of 15.77% since inception. And they started this ETF on May 22, 2012. So the SPDR Aristocrats ETF started on October 14, 2011 and has an annual return rate of 13.02%. So that's a 2.75% difference in annual return, what makes a big difference on bigger numbers and more years. And suppose I enter these numbers in the investment calculator. And in that case, you can see here that a $100,000 initial investment with a monthly contribution, as you can see here, of $1,000 will result in a total end balance of $703,000 with an annual return rate of 15.77% after 10 years. So using these same numbers but with a 13.02% return rate result in $574,000. So that's a difference of $130,000 in favor of the S&P 500 investor. But the thing is, while you're in retirement, you probably prefer to have a more consistent stream of income. And therefore the dividend ETF might be the better choice in retirement than solely relying on the S&P 500. So then there are some more dividend lists, such as the Dividend Champions, the Dividend Kings list, the Blue Chip Stock list, and probably way more. Number 5, don't only focus on the highest paying dividend companies. So suppose you don't choose to buy an ETF and instead you want to pursue purchasing individual stocks yourself. Well, good for you. In that case, the author of the book Dividend Growth Machine recommends that you shouldn't solely focus on the highest paying dividend companies. So the author states that stocks with a yield of 6% or more per year are often a good candidate for a dividend cut. And it's better to own stocks of companies with a consecutive dividend growth than a stock that's on the edge of a dividend cut. So since the author of this book refers to other books for stock selection, this isn't the book that tells you exactly how to pick winning dividend stocks. But he did mention one tactic, and that is to pay attention to payout ratios. Yes, payout ratios. So for example, let's say Apple's dividend payout ratio is 30%. So that means for every $10 of Apple's earnings, they pay $3 to its shareholders, the 30%. So the higher the payout ratio, the less likely it is to maintain its dividend growth. For instance, a 90% dividend payout ratio is really high, and such a company will likely cut its dividends soon. So learning number 6. Dividends get paid regardless of what happens to stock prices. So in one of the book Dividend Growth Machine chapters, the author explains that dividends get paid regardless of what happens to stock prices. So in my opinion, this is a pretty bold statement. And he doesn't refer to any article or study that support his claim. Although he might be right in some way, I know for a fact that a giant Dutch oil company, namely Shell, had cut its dividends in 2020 for the first time since World War II. So the main reason why many people invested in this company was because of its dividend track record. But in 2020, the company cut its dividends by 2/3 because of the global pandemic. And besides the dividend cut, the stock price also fell by 15% or even more, if I recall that correctly. So it's definitely not always the case that dividends get paid regardless of anything else. And maybe the example I just gave is 1 out of 100 or maybe 1 out of 1,000, I don't know. Anyhow, this alone hopefully convinces you that you don't want to be overexposed to only one company. Conclusion. So many of the learnings you find in this video are my takeaways from reading the book Dividend Growth Machine, How to Build a Worry-Free Retirement with Dividend Stocks, and the research I've done while reading the book. So reading that book and the research I've done so far helped me to understand dividend investing better. However, it still didn't convince me to make a final decision whether I want to pursue dividend investing or not. So the way I see it is that the S&P 500 still outperforms all of the dividend investing ETFs. And looking at my investing horizon, I believe my best chances lay in investing in the S&P 500 ETF. But this isn't my final call. I'll keep on reading and keep updating you guys along the way. But what about retirement? So the sole reason I'm doing all this research and make my financial sacrifices is to make sure I'm financially set for life, right? But should you hold dividend stocks while in retirement? Or should you go for bonds? Like, should you have a portion in the S&P 500 ETF and a part in bonds? Or should you go for a position in the S&P 500 ETF and a position in dividend stocks? Or 100% dividend stocks? Or maybe something else entirely? And you may already know this, but a common retirement investing strategy is holding a portion of your money in stocks, like the S&P 500 ETF, and a part of it in bonds. So for example, the author of the book The Simple Path to Wealth, which is all about index investing, has, if I recall it correctly, 20% or so in bonds and 80% in stocks in retirement. So for example, Vanguard offers various bonds ETFs. So in this particular bonds ETF holds more than 250 US government bonds. So the US government's chances of going bankrupt are pretty slim, and therefore it's a pretty relatively safe bet. So this bonds pays a 1.25% yield per year and distributes its interest every single month instead of quarterly, what is often the case with stocks. So especially if you have no active income, a monthly distribution of such consistent bond payments is nice to have in retirement, right? Also, the chances of the bond's price going down is relatively small with the lower risk bonds. But the thing is, to receive over $1,000 per month from such a bond ETF, you need to have $1 million invested in these bonds, which is a lot of money. And besides the Treasury Bonds ETF, there is the Corporate US Bonds ETF, which has a higher risk and yield, of course. The corporate bond ETF has a yield of 2.71% per year. So this ETF holds close to 6,000 different corporate bonds of companies like Microsoft, Verizon, AT&T, etc. And to receive $1,000 per month in bond income of this corporate bond, you need to have $450,000 invested into this bond. So that's a big difference with the treasury bond, where you need $1 million invested in receiving $1,000 per month. So if you learned a thing or two, make sure to leave a comment and tell me what you took away from watching this video. And if you want to follow along in my investing journey, make sure to subscribe to my YouTube channel. And just FYI, if all of this went a bit too quick for you, I've summarized all the pointers I discussed in this video in this new blog post. You can check it out on my website. I'll leave a link to that blog post in the description below. Thanks for being here, my friend, and hopefully we'll meet again next time. Bye bye.